You're listening to the All-Star Charts podcast with JC Peretz on TechnicalAnalysisRadio.com.
All right, everybody, welcome back. We are here with Robert Sluymer. Robert is the managing director at Fundstrat Global Advisors. Rob, thanks for being here.
Well, thanks for having me on, JC.
Been a big fan of your work for a while. Seen you give presentations and see media that you do and stuff like that. So I have a huge appreciation for your perspective, particularly from a technical standpoint. Before we just start diving into the market and Bitcoin and all that, why don't you tell me a little bit about what you're doing now, sort of your experience at RBC, right? You're at RBC for 27 years?
Yeah, that's correct. So I'm working with Fundstrat. I work with Tom Lee, who was JP Morgan's lead strategist for about 10 years. He's got an independent macro shop. They brought me on a couple of years ago after I left RBC. It's been a really interesting experience. As many of the listeners probably know, Tom's a big fan of crypto. So that's a unique business for us to be involved in. My expertise, if there is such a thing, is really in just general traditional capital markets. I'm a big fan of the equity market. I love doing technical work on stocks, industry groups, markets in general, long-term cycles. And it's been a philosophy that we used when I was at RBC for 25 years, really just institutionally driven and, trying to make people money and trying not to lose them money. And I think technicals is just an absolutely excellent way to do that.
Well, you're not going to get any arguments from me, Rob. let me ask you this. What was your role specifically at RBC? You were in institutional sales, or did you help how did that work?
So I started at the very bottom of the firm in the back office in what's called the cage. It's where all the trades settle. I was there for about a year, and a posting came up this is back in 1991. I was living in Toronto at the time. And posting came up for a research position to work with the technical analyst. His name was Ray Hansen, somewhat of certainly a legend in Canada, at least to me he was, and really trained me from the bottom up as his associate. I was in Toronto for maybe 3-4 years, and we had a pretty big group in New York. It was the first institutional equity business for RBC Capital Markets back in the 70s, so it had a very long tradition. The systems that we had in place, it was one of the first electronic graphics systems in the world. And it was something that RBC didn't capitalize on. They eventually sold it to Reuters, I believe. And they had a philosophy of looking at market cycles and relative performance and combining those two. And it's a pretty effective way of looking at the market. I moved down to New York in 1996, and I've been here ever since. So I was the lead technical strategist for RBC institutional product. We had a very nice team down here. And then eventually, like most other sell-side shops, they began downsizing, cutting back on all sort of senior personnel, or many senior personnel, analysts, traders, and our business got chopped in that shutdown, and I came over to Fundstrat. So it's been a great career. I have nothing to complain about. It's been a good ride.
No, it sounds like it. And being able to work in multiple cities, one of those being New York, and I personally love Toronto. So, that must have been a good time.
Yeah, they're great cities. Great cities.
You could definitely have been in much worse places. So when you talk about how, a lot of the institutional firms are downsizing, how is that trend? Because you know more than me on that side. What do you see the future of that?
For technical analysis in general?
From an institutional standpoint, right? Because there was Merrill Lynch had 25 technical analysts or something like that back in the 90s. Now I think they have 2 or something like that. So how is that? Where's the evolution of that going to go, do you think?
Well, it looks kind of grim for the sell side business of technical analysis. I think there's a niche business. Independent macro shops can certainly carve out businesses, but at the end of the day, I think that when we look across most of the capital market sell-side businesses, everything has to have a dollar attached to it. You have to monetize your business. I think we had a pretty good business. I certainly brought a lot of it with me to Fundstrat. And so from that standpoint, it continues to grow. But I think for many shops, macro research it's not a banking business, right, JC? So if it's not a banking business, it's tough for a bank to capitalize it in the same way that they can on primary fundamental analysis. So to a certain extent, I think that the trend for technicians is going to have to be on the independent side. And to a certain degree, I think that people coming into the business that want to be technicians need to think about, at least this is my view, need to be thinking about using technical analysis as part of a broader toolkit in order to do as part of their financial process. How are they analyzing stocks and bonds? So combining technicals and quantitative and fundamental. It's almost like somebody being a PE expert. You just can't get a job doing that. So I guess the other way I would look at it is I can't imagine, or I never really understand why any person running capital, managing money, analyzing stocks wouldn't use technical analysis as part of a broader toolkit. There's so much information in there. You don't always have to rely on it, but it certainly provides so many risk management tools. There's divergences that show up that you'll never see in tabular data or in written reports. I think, and if you just look at the CMT program in general, I just think it continues to grow. So more and more people using technical analysis, less and less jobs as pure technicians is my view.
Let me ask you this, if you have the same experience as I have, but even the hardcore fundamental guys, like PM guys, you're in their office and you talk about whatever symbol, whatever it might be, the stock of the day. Tell me that the first thing they don't do is pull up a chart.
Always. 100%. And then we can sort of debate what sort of chart they have up. I think if they're Bloomberg users, the GPO is a very standard use. If they're FactSet users or Reuters, but I'll tell you some of the tools that people apply, and everybody has their favorite indicator. I'm a big fan of relative performance versus a benchmark versus an underlying sector or an industry group. I think there's so much information in there. We can debate the value added of certain momentum indicators or moving averages, but relative performance, to me, everything is relative. It's relative between asset classes, stocks, bonds, and currencies, and commodities, and within asset classes. Certainly, spreads are a big deal in the fixed income market, but within the equity market, that relative performance shifts between sectors. I wouldn't say I live and die by it, but it's a really important part of how I view the market and where I see capital flowing.
There's absolutely no question about it. I look at momentum, I look at relative strength, and that's it. I mean, from just a chart to chart standpoint, but you talk a lot about the cross asset stuff, right? The intermarket work that you do. It's not just semis relative to the S&P, but stocks versus bonds or gold,
Sure.
right?
Yeah, I think I sort of look at it from the standpoint, there's four main asset classes, right? Stocks, bonds, currencies, and commodities. And the capital is flowing in and out of those asset classes or pushing back and forth, almost as though it's in one big pie. The money globally, and obviously there's other asset classes out there, but those are the main ones. Those are the investable ones. And as capital pushes from one to the other, it's going to impact all four of them, which in turn impact each sector in the market, which in turn impacts each industry group and stock. So I look at it from a top-down standpoint. What are the asset classes doing? How is that impacting the 11 sectors in the S&P 500 or 1500, whatever benchmark you want to use? And then, I have a suspicion you do a very similar thing. It's from a bottoms-up standpoint, just looking at all the charts. And yes, people can systematize that and quantify it, but there is nothing. I see you tweet about this all the time on the weekends. It's the end of the week. You're sitting down with a glass of wine. You're looking through the data, or it's month end, whatever the case may be. But there's nothing more informative than looking through a long list of stocks. You just take the time, get yourself in a comfortable place, and just review the data, stock after stock, and the price patterns and the relative performance patterns. There's so much information that comes out of that I just do not see when I look at tabular data or summaries and whatnot. You can see little shifts developing. If we talk about the semis, for example, the price patterns start to bottom, and then one name starts to take off, and it's kind of a marquee name, whether it's whatever, AMAT or KLAC or LAM or whatever it might be. And one name starts to lead, and it just continues to lead through the bull market. KLAC seems to be the case now in the semi-cap equipment names. But looking through all that data from a bottoms-up standpoint and then marrying it with what you see from a top-down standpoint, it's, aside from being incredibly satisfying, there's a tremendous amount of information and very, very useful. And what I find so fascinating is when you sit down with institutional portfolio managers, any portfolio manager, retail or institutional, but certainly with the institutional guys who are running big books, 55 billion plus, whatever the case may be, right down to the hedge fund guys running a couple $100 million leverage, they don't see the data the same way we do. They're not, when you bring in chart books, when you review data with them online, you always get the response, oh, I never realized that turned back in October, or whatever the case may be. A good example is the semiconductors, which I use as a very important barometer, as a leading indicator for the market. Not always, but often in market cycles. And the relative performance for the semis bottomed in October of 2018. So we still had that down leg to go through the semis in December as the whole market caved in. But the semis never made a new relative performance low, and they continue to lead. And they're still leading. I mean, they broke out to all-time new relative performance highs just over the last couple of weeks. So that's sort of a rambling way to sort of argue or make the case that as you go through the data and you just look at it visually, there's really nothing as good as turning over every stone, every chart, take a look at it, and derive the information that way.
And why do you think it's so difficult for so many people to accept that as a valuable practice to do on a regular basis? You and I, we've done this forever. So like for us, we've seen the value for so long that to not do it seems like idiotic, right? But for other people, why is it so hard for them?
Yeah, I don't know. I'm always surprised. Let me answer that in two parts. I'm always surprised who is interested. You think about folks that are really die-hard fundamental analysts or managers, and you often get that in the value side of the equation, right? The deep value. I'm looking for stocks where the chart patterns are ugly. The valuation is incredibly cheap. Many folks have talked about Bed Bath & Beyond as a deep value stock, but they've been doing it for a year, right? And I think when you are looking at value, there's a real strong incentive to ignore price. Somehow you know better than the market.
Oof.
And as a technician, I never know better than the market.
Never.
I'm always the dumbest guy in the room. I'm always the first to admit it. And I have some very simple observations and things I can point out. And that's where the line stops. I don't, you don't come off as trying to be smarter or telling people what's going on. You can just point to what's happening. And then I think there was a client of mine who had a very good presentation once at one of the CMT symposiums, and I may have this wrong, but he made the point that price, if you put price on the left-hand side of the equation, and I think it's equals value plus maybe growth or management, something like that, V plus G. And he says majority of the analysts, PMs, spend their time on the right-hand side of that equation, and the technicians spend their time on the left-hand side of the equation. And they really do eventually end up equaling each other. So there's nothing wrong with looking at price, but I can't understand why people don't incorporate it into their view. Somehow, maybe it's too simple. Maybe it's too enjoyable.
Some people, my wife, I'm looking at charts and I'm like sitting there like laughing, just chuckling to myself because sometimes the market does funny things, right? That I find the humor in nobody else. She's like, I thought you're supposed to be working. What are you laughing at? I'm like, oh my God, if you only knew. So
That's right. That's right.
We find humor in interesting places. You mentioned 4 asset classes, right? And the obvious one missing to me is cryptocurrencies. Now, from an institutional standpoint, obviously, they're the 4 main assets. For everyone else in the world, you can be in the crypto world. And you mentioned that Bitcoin is a big part of a part of the business that you guys run. Like, do you let your fundamental, perhaps, views get in the way of your technicals, or do you look at it purely technical? How does that work?
On crypto specifically?
Yeah, like Bitcoin.
Yeah, well, I don't have any fundamental views on crypto. I find it one of the most fascinating developments from an asset class perspective. Like, what is it? It trades 724. There's no particularly underlying fundamental value. I guess there's some network value people would argue about, and it moves around in ways that I've never seen asset classes. Just look at what happened this week. It went up 40%. And what's so fascinating about that, JC, is that it rebounded from a very cliche and classic 62% retracement of the decline that we just saw through 2019 to the back half from the June 24th highs. So it does respond to technicals. It may I don't know if it only trades on a technical basis, but it's certainly a big part of it. But I don't I mean, Tom Lee has very strong fundamental views and is obviously very steeped in what it is and how it works. But as a technician, I try very hard not to let my views be influenced by what I think. As one client says, and all my great sayings come from clients, um, trade what you see, not what you think. And that keeps you out of a lot of trouble. Think about the stock market this year, right? If you traded what you thought and responded to the headlines, the negative headlines, and all the deteriorating economic data out there, you would have long sold the market and be expecting a recession. But if you trade what you see, market seems to be holding in very nicely and is on the verge of breaking out or trying to break out with the right kind of groups starting to come in and provide leadership. It keeps you out of a lot of trouble. And so when we talk about crypto, we've got some pretty difficult chart patterns, big gaps, still in downtrends. Interesting to see a BTC rally just to the upper end of the trend channel that it's been in since the June highs, right? So it does respond to some technicals. So to actually answer your question, I don't really have a very strong fundamental view on Bitcoin.
I think Bitcoin since day one for me anyway, I started following it in 2016. That's when I got, or maybe 2015, something like that, in terms of like the charts and everything. Prior to that, I knew of it, but I had never really started to chart it until that point. And for me, I was just always like the Fibonacci levels, like you mentioned, not just the retracements, but the
Yes.
extensions too, going back forever.
Right.
Like, oh my God. But moving just,
Well,
if we can hang out above 9,800, 10,000, if we're above that, I mean, I don't see any
exactly.
reason not to own it.
Exactly. In fact, I'm just publishing a note on it today, actually. But the recent highs that we put in, if we can get above that, which you just articulated, that's going to be a very bullish signal, I think.
Form of support.
So now we have
right?
a little bit of a pullback coming in, right? So it starts to come back in. Does it stabilize? We don't know if it is. I think it will. But we could be up for another pretty bullish up leg. It looks very similar to what we saw in 2016, right? Went sideways, and then it started to take off again. In fact, what's interesting is the action. It's a little bit different in crypto this year, but the equity market and the crypto markets are behaving like it is 2016, from what I can tell. The market cycle data lines up. The action in the groups is lining up at the equity level. Bitcoin's been volatile, but what's interesting, in 2016, it retraced 62% of the prior bear market. Then it went sideways, and then it took off again. And that's exactly what it did this year. So retraced 62% into the June high, had this big correction. It basically had another 62% correction, and then it's taking off again. So it's just absolutely fascinating. I think it's one of the most interesting asset classes that's developed since I've been in the business.
All right, so I think you agree that if we're above that former support from the summer this year in Bitcoin, which is,
Yes.
let's call it 9,700, 10,000, something like that. If we're above that, looks good. And what about S&Ps? What about stocks? Do you have any important levels similar?
Yeah, I do. I think if I can just ramble a little bit on my long-term view on the stock market, and I think that'll tie into the levels and what I think is developing here.
Sure.
Folks, I think that certainly many technicians, and certainly the technicians on Twitter, tend to be very short-term oriented. Not all of them. I don't want to slate everybody, but there's a lot of sort of intraday trading and very near-term support levels. But I think what people miss, and what is so critical, is to stay very focused on the long-term trend of the market. And as most people listening to this podcast, I hope are aware of, when we look at these secular trends that have been in place, the 50s and the 60s, the 80s and the 90s, and what I think began in 2009, but really accelerated in 13, and in particular 16, there's some very long-term cycles. They run in 17, 15 years, whatever. We can sort of round it off. But I think that there was a major inflection point in 2016. That's where the sort of 35-year bond year cycles line up with the 17-year equity cycles. It may sound a bit flaky, but the visual representation of it is so powerful. And the market tends to skip off the 200-week, the 4-year moving average, which kind of makes sense, right? The market rallies off of a so-called business cycle, and then it contracts for a year or so. If we're in a secular bull market, then that trend should be, 2 to 3 years up, and then a year or two or a year and a half sideways to down. And very clear in the 50s and 60s. The pattern holds in the 80s and 90s, and the lows in 2011 to late 2011 into 2012, very similar off that 200 week. But 2016 was almost textbook, right? We had cyclicals correcting for almost 2 years. They peaked in 2014. And incrementally, the market began to sort of fold over one by one. You lost industry groups until the market actually collapsed right down to that 200 week. It was one of the most bullish calls I'd made in my latter years at RBC, and got a lot of recognition from clients for it. It just seemed like a layup to me. And what we saw in the fall of 2018, and I have to admit, you had a great call in the fall of 18. You were looking for the market to sell off, and you nailed it. I did not anticipate the crack in December of 2018. But once it hit that 200-week moving average, and it did so within a point, 23.46, I believe was the low, and then the market began to rebound. We had all those divergences set up, right? Semiconductors, lumber, copper, all began to show evidence of bottoming in October. So many things did not make new relative performance lows, and it was such a green light to stay bullish on the market. And so what I think is happening here is just very similar to what we saw in 2016. If you look at the average rebound in a secular bull market off that 200 week or at the 4-year cycle inflection point, because they're not perfect, it's around 100%. And the minimum move is around 62 to 65. Well, interestingly, the rebound off and I realize this sounds a little bit hocus pocus with numerology, but the rebound off the 2016 low, I think that was an 1810 low, basically got you at a 65% return or 62% return, basically to that 3000 level where we peaked in 2018. And so you start looking at upside levels from here, and if those are just, I think of these as frameworks. I'm not married to that as a target, but those are possible projections where this could go. This market cycle could take us out to 3,800 fairly easily over the next 2 years, and that would be the minimum move, 3,800, 3,850. And we could see something, and this is going to sound a little ridiculous, but 47 to 4,800 would be just the average move off that 2346 level. So those are some big numbers.
Yeah, but when you put it into context and you zoom out, right, as they say, whenever in doubt, zoom out, it really isn't that far-fetched at all. Not at all, particularly with the sentiment. People are like, well, what's going to be the catalyst? Well, it's like, well, people got to buy because they've been trying to sell, right? Talk to me about sentiment, where we're at.
Well, there's a variety of indicators out there. None of them are perfect, but when you pull them all together, one of them, the ones that I like to see, and I have to rely on clients and other people to send me this stuff, but the most recent one that really struck a chord with me was the Merrill Lynch Fund Managers Survey. I think it came out a week or two ago. Majority of investors overweight bonds. Majority of investors overweight defensive bond proxies, staples, utilities, and underweight equities, underweight cyclicals, materials, energy, consumer discretionary, and financials. And when I look at the charts, what I see are 12 to 24 month consolidation corrections in cyclical stocks. Again, right back to that 200-week moving average, which is such an important trend line support level. It's not perfect, but boy, I can't tell you how many times you see stocks break through the 200-day and all the red lights go on and people are nervous. And I just say, well, look where the stock is. It's almost back to the 200-week, like the market. And so when you look at names like Caterpillar and a long list of industrials, ITW, PACCAR, Cummins, URI, banks like JP Morgan, Morgan Stanley, all these names have either consolidated for a year to 2 years and accelerated off those long-term trend support. Maybe the relative strength's been a bit funky. It hasn't been as strong as, say, Master or Visa card. So those are pretty tough benchmarks to compete with. But in general, the patterns they've gone sideways for a year or two and are starting to emerge and break out. So whatever the economic data, and all this stuff can turn around, obviously, at a drop of a dime, or drop of a hat. But I don't see these patterns as negative. Semis are accelerating. Industrials are responding to bad news. JP Morgan makes a 2-year high. it's an incredibly bullish setup. And the fund manager survey only supports that, exactly like you say. What's the catalyst? Nobody's there. Everybody's on the wrong side of the boat. Everybody owns utilities and staples. And there's nothing wrong with those stocks. They're just extended and starting to correct, like McDonald's, a very classic defensive name. Yeah, so we're still very encouraged by what we see, and we think there's tremendous more upside through year end and well into and through 2020.
You know, one of the things that I get all the time is like, well, JC, you know, defensive rotation. I think that we've proven that with semis making new highs and discretionaries creeping up, you know, that defensive and tech, you know, defensive rotation, I don't buy that at all. For me, it seems like more of the fact that you REITs and UTs and staples, I think a big reason for their outperformance is some of the interest rates, right? So with, let's just say stocks make this move, we move substantially higher. I agree. I'm totally with you. Everything you said, you're basically saying the exact same thing I am. So no complaints there. But where do rates fit in that scenario?
Yeah, it's sort of like the black hole of negativity seems to surround the rates, and certainly what we saw in the summer. And I got to be very candid about it. I didn't expect rates to fall as far as they do, which is, that's not unusual at the end of a move, whether it's on the upside or the downside. Everything extends a bit farther than you think. But it's really interesting when you look at the 10-year bond yield, just as the proxy for rates. Obviously, a lot of the negative rates globally, but if the 10-year is sort of the lightning rod for what's happening in the global economy, and I'm sure many people will disagree with me, but anyhow, the point being that we've just come down and effectively retested the lows around 130-ish for the third time. And so when you look at the secular downtrend for rates, that's where the 10-year bond yield failed, right, in 2018, around 3.25, almost exactly at that linear downtrend, assuming you're using a logarithmic chart. And we've come all the way down to the bottom of the range. And when you look at it from a secular standpoint, if what we think is happening with these long-term market cycles, that is, we're starting a whole new round of a 17-year move, which is support equities, believe it or not, into the early 2030s. And that argues that rates are probably putting in a secular low. But we really don't have evidence of that yet, right? We can't make a case that the trend in the long bond has reversed yet. But there is evidence that some type of low is developing. The monthly RSIs at extreme levels. Pick your momentum indicator.
And the 30-year yields?
Basis.
30-year yields?
On the 30-year, yeah, 30-year or 10-year, all the long bonds. And when you look at the weekly momentum data, as you start nesting the time frames within the longer time frame, we've already seen the extreme low develop there, so that's unwinding. And then on a short-term basis, you have you've got higher lows in place on the 10-year. Now, I think 2% to 190 to 2% is the recent highs that we had in September, if I remember correctly. And you're going to have to get through that to really make a case that you have at least a tactical or intermediate term turn in place. But JC, I got to tell you, I look at the TLT and I think of this as probably the most liquid, outside of the actual treasury market, the most liquid instrument that people have piled into to use as a tool to get bond exposure.
Yeah.
And right here, right now, yes, it's putting in a short-term low, just in the way the stock market is probably putting in a little bit of a pause or a short-term peak, risk assets in general. But it looks to me like that TLT is in the process of completing a pretty big top. It makes me very nervous. And if I sort of had to make a bit of a forecast here, I think it's going to break very hard. And people are going to be caught offside in what's supposedly a low volatility defensive place to be.
And why a top? This is where it peaked back in 2016?
Well, we have on the TLT at least, we have lower highs in place. Mm-hmm. Again, that's more of a tactical intermediate term call. And the trend line's not perfect, but if you go back on the TLT and look at the sort of progressive series of higher highs, it doesn't line up perfect. You wouldn't put it in a textbook, but you're starting to see all the intermediate term momentum data peak as you get to this extreme point well above trend.
So you think bonds get slammed?
I do. And part of that is based on what I see happening in the equity market. And what I see, as I said earlier, so many of these cyclicals have really just marked time in a 12 to 24 month trading range. they're starting to incrementally improve in relative performance, and they're all this is it's a huge sweeping generalization, but many of them, most of them, have effectively consolidated to their long-term uptrends. So I think the response to that is incrementally to the upside, and I think it could be pretty explosive. And so I think bonds get damaged on the other side of that. And I think you see it in the global markets as well, right? Europe is starting to reverse its downtrends. After putting a low in December, you have the big bounce, you've consolidated sideways, and now incrementally they're starting to move through the highs, that summer consolidation, that all that uncertainty we had. But incrementally, these indices are responding to the upside. It looks like the second leg in a bull market taking hold.
Yeah, no question. So, I mean, it's just that's for me, that's where intermarket analysis really helps. You know, I have similar views, maybe not as strong as bonds are going to get slammed, but I don't see any reason to buy bonds, certainly. But
Right.
if the
That's
stock
probably,
market's going to rip, bonds fall, rates go up, you know, I could see all of those things happening simultaneously, right?
yes. And I think you put it well. I mean, that's my recommendation to clients in general. Folks that own McDonald's or Procter and Gamble, or a long list of bond proxies, utilities, Kimberly, Hershey's, and whatnot. These are not bad charts. These are stocks that are still in long-term uptrends that are pulling back within those uptrends. So it's not a function of sell them all, roll out of it. It's more a function of take some money off the table, consider adding to some of the cyclicals that look like they're emerging, and protect what you have in place. And particularly for wealth managers who have an income component for their clients, they're not going to sell all this stuff to buy high risk semiconductors that have no dividends. So it has to be within the context of a diversified portfolio that I think most PMs are trying to manage for their clients.
All right, Rob, I got another one for you. So in this scenario, right, I think, correct me if I'm wrong, I think you'd agree we'd probably get some rotation into emerging markets, maybe even some outperformance. That's most likely happening in an environment that the dollar is weaker.
Yes. Yeah, that's a good one. So what's happening with the dollars? That's what you're driving at, right?
The dollar, EM outperformance, rotation into that area. Like, is that
Yeah.
part of your vision, if you will?
Yes, it is. I think if the dollar's been pretty frustrating, I thought it was going to peak out earlier, and I was wrong.
I did
And
too.
and I'm sure you've listened to many people with a much better understanding of the plumbing of the front end of that yield curve, right? All the repo stuff, all the dollar funding crisis and whatnot. It's really outside of my expertise, but I pay attention to it, and so there seems to be some distortions there. But the dollar seems to be weakening now, certainly after the recent non-QE QE, and it's very consistent with this rotation to more cyclical areas. Certainly EM and global markets in general are more cyclical than the S&P 500. They have less technology in them, and so there's less secular growth in most of those indices. And so I do think the dollar is weakening. It's broken its 2018 to 2019 uptrend. So maybe we get a little bounce back. I thought the action today going into the close was really interesting, right? We had Powell speaking, market's a little uncertain. The equity market starts to rally. Some weird stuff happening in the bond market. The 30-year, the curve flattened, and yet the 2-year firmed up, and yet the dollar did not. Right? So the dollar's coming in, which is exactly what I want to see. I think currencies outside the U.S., whether it's the euro, Canadian dollar got hit a little bit today, but the euro is starting to come on. I think that's all going to be positive for EM. I think the context, though, is when you look at the very long term, the structural trends in EFA and EM versus the S&P 500, they're still in very clearly defined relative performance downtrends on a dollar-adjusted basis.
Yes.
So it's really early to be making a strategic call that we have a new structural uptrend in markets outside the U.S. I'm not making that yet, but when you look at the relative performance trends of those markets tactically, and if we use that 2018-2019 time window as a sort of a way to frame it, then you are starting to see the relative performance downtrends reverse to the upside, favoring EFA and EM and global markets. So I think certainly within the context of a portfolio and making tactical changes, move a little capital to the EM, a little capital to EFA, Europe, a little more money in cyclicals, take some of that capital out of the bond proxies that have done so well for much of 2019. I think it's just making moves on the margin.
You mentioned the United States relative to EFA, and for those who don't know, that is basically developed markets outside of North America. So, but it's a lot of Europe. But within that EFA is also Japan. So you mentioned relative lows in EFA, relative lows and downtrends in versus emerging markets. But Japan held those on a relative basis, held those summer 2016 lows, which coincidentally maybe, but is also right when US interest rates bottomed as well. So we have an interest rate low in the summer of 2016, Japan relative to the S&P 500, Nikkei S&P specifically, and making a similar low at the exact same level. I mean, is that just a big coincidence or no?
Well, I who knows what coincidences are, but Japan tends to be a bit more of a cyclical market, right? So I think all the pieces fit in. Maybe they fit in too well, JC. That's the one thing that concerns me. The picture is almost too perfect, you know. But I think of Japan as being a very cyclical market. Obviously, a lot of auto exposure there, but I don't think it's a coincidence. I think it's all part of the bigger picture.
The cyclical story. So Japan outperforming is part of that cyclical story with semis and emerging markets rotating and all that stuff. Yeah, I'm totally with you. Now I will make it difficult on you. Now, if the dollar's falling, where does gold fit in the story?
Yeah, that is a difficult one because the pattern for gold is actually pretty intriguing, right? We had a peak in 2011, all that basing through 18 and 19, and an explosive move to the upside. All the weekly data has peaked, right? If you look at a weekly, pick your indicator, RSI, MACD, stochastics, we have our own, but they're all kind of the same thing, tracking that, look back period of 1 to 2 quarters, and that all peaked a few weeks ago. And so we've been cautious tactically, but I'm not ready to make a call that the whole pattern's failing. As one of my clients likes to say, Rob, everybody comes in here with these beautiful macro stories and everything fits together perfectly. I like it when you got a story that doesn't fit. And when I look at gold, and the story often is told that it's a function of real rates, real interest rates. And so when real rates fall, gold should do better, like it did in the 70s, like it did just going through the latter part of the summer here when rates started to move negative. But it looks to me that 1500-ish level is pretty good resistance. And as you get down into that high 1300s, low 1400s, there's a lot of support there. And so I'm going to play that pattern just off the technicals. And I'm not going to try to overthink it too much. So I think that as we move towards the end of the year, that weekly momentum should unwind. Gold should be at a point where we want to be adding back to it. So maybe some of the other story, maybe some of the other cyclical side of the market or our view on the equities has to change, but maybe gold's sniffing out inflation. I don't know, but the pattern is, it's not overly bearish to me, and I think it's just in a pause here. What are your thoughts?
I came into the year, it's funny, I came into the year super bullish gold. In the fourth quarter last year, the commercial hedgers were actually net long. And, as you know, gold, and the hedgers there actually do hedge. They're never long. They were actually long. So it's one of the reasons why we're so bullish. And the big pattern, right? The big bottom over the last 6-7 years that we all see, right? The bigger the base, they call this something like this, the Kardashian bottom, right? Big base. Right?
Yeah, right.
So, I mean, we all see it. So there were a lot of reasons to be long, right? But a big reason was commercial hedgers were super bullish. And now it's the exact opposite, right? They have one of the largest net short positions in history. So for me, I still think that we need to see some positioning unwind before I can get back on the gold trend.
Got it. That makes a lot of sense.
I still see that big base, right? And then if the dollar's falling, I can't imagine gold is getting killed in that environment. So it's kind of just like back off for a little while. It's kind of how I'm thinking.
Right, and we go back to that weekly momentum, and these 1 to 2 quarter shifts that I find weekly momentum indicators tend to be fairly good to track. That just means we've got some time to pass, and maybe the whole story changes. We'll see how it acts as it gets back into support. But I think there's other more attractive markets to be playing from the long side than gold at the moment. So I'm just taking a pass until that data sets up again.
I could not agree more. Oh, you took the words right out of my mouth. How beautifully put you did that. I like how you said that. It's so true.
I think you'd written that down. No, I'm just kidding.
I mean, it sounds like something I'd say, but I mean, yes, it's absolutely beautiful. And then one other thing that I want to touch on, just I think this is a good point for everybody listening. You mentioned how you wanted to, and I'm just using this as an example, how you want to look at gold more specifically instead of overthinking the intermarket sort of relationships, because it's so easy, especially for guys like you and I, to really get lost in the, well, if this happens to stocks and this happens to bonds and then this is going to happen to the dollar, and then you're on the seventh derivative by the time you actually put on the trade instead of exactly what you said. Forget everything else. Focus on what's in front of you.
I'm so glad you said that, because I can't tell you how many times over the years I've blown myself up with a great call on oil or a great call on interest rates, and I've gotten the energy stocks, relative to oil, completely wrong, or making the right bond yield call and getting the bank stocks wrong. So, and at the same time, there's times where we've nailed the gold call and gotten the gold stocks wrong. And so while there's a couple points here, but I think the key thing, and that's one of the reasons why I think it's so important that you just flip through your library of macro charts every week or every day. I do most days, but certainly on a weekly basis, there's a huge volume of charts that we look through on a top-down basis, but equally important, you got to do it from the bottom up. You got to look at the stocks, because there's so much information that comes out of those stocks, and the stocks are always right. And you've got to invest in you can invest in whatever you want, but for equity investors, and that tends to be the bulk of my business, you're investing in stocks, individual equities. And so the price action there tells you an awful lot, and sometimes it completely diverges with what's going on in the underlying commodities or in the macro space. So you got to be really, really careful overstating and overthinking and overlinking the price action. Sometimes things just diverge. I'll go back to what my client says before. He loves it when stories don't make sense. Oil screaming to the upside and all the airlines are working. That's not a normal environment. But if the stocks look good and they look timely, trust the stocks.
You are going to get zero arguments from me, Rob. Ladies and gentlemen, Robert Sluymer, Managing Director at Fundstrat Global Advisors. Rob, thanks for being here.
Thanks for having me, JC.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.